Hey, welcome back. Today we are tackling one of the most powerful and, honestly, most misunderstood forces in all of our financial lives: interest rates. Look, whether you're saving, borrowing, or just trying to figure out what's going on with the economy, this is something you got to get a handle on.
So let me ask you this. Have you ever felt this? You put money into a savings account and it just creeps up ever so slowly. But then you look at a credit card balance and it feels like it just explodes overnight. Well, there is a very real reason for that. And I promise by the end of our time here, you're going to know exactly what it is. All right, here's our game plan. We're going to start with the absolute basics, what we'll call the price of money. Then we'll get into the two different faces of interest, which is the real secret sauce. We'll decode some of that financial jargon you see everywhere, zoom out to see how it steers the whole economy, and then bring it all home to see how it really impacts us in the real world. Okay, first things first. Let's strip away all the complicated stuff. At its core, what even is an interest rate? The easiest way to think about it is this. An interest rate is basically the cost of money. That's it. If you want to use someone else's money for a while, like a bank's money for a mortgage, you have to pay a rental fee for it. That fee, that percentage, is the interest.
So, what goes into setting that price? Well, it's a mix of huge, big picture stuff, like how the entire economy is doing, and really personal things, like your own credit score. But if you boil it all down, it all comes back to one simple word: risk. The less of a risk the lender thinks you are, the lower the price, the lower the interest rate they're going to offer you. Simple as that.
Okay, now we get to the part that really answers that question from the beginning. See, not all interest is the same. There are two totally different ways it's calculated, and trust me, the difference between them is absolutely massive. So on one hand, you've got simple interest. This is calculated only on the original amount you borrowed. It's flat, it's predictable. But on the other hand, you have compound interest. This is what people call interest on interest, and this is where the magic or the trouble happens. With compounding, the interest you owe gets added back into your total balance, and then you start paying interest on that new, bigger amount. One grows in a straight line, the other one just takes off like a rocket. All right, let's make this super real. Imagine you've got a $300,000 mortgage. The interest rate is 4%, and the loan is for 30 years. So, how much interest do you think you'd pay in total with each of these methods? Okay, with simple interest, the math's pretty straightforward. Over those 30 years, you'd pay a grand total of $360,000 in interest. Now, just pause and think about that for a second. That is more than the entire original loan. And believe it or not, that's the good news. Yeah, what happens when we use compound interest, which is how most loans like mortgages actually work? That same exact loan would cost you almost $673,000 in interest. That's a staggering difference of more than $300,000. This is the engine that makes debt feel like it's growing out of control. And that is the answer to our opening question. But here's the beautiful part. This incredible, powerful force, it can also work for you. When you put your money in a high-yield savings account or a CD, your money earns compound interest. It becomes your absolute best friend, growing your wealth all on its own year after year. Okay, so let's talk about where you actually see this stuff in the wild. You've definitely seen these letters before, APR and APY, plastered on ads and loan documents. And I'm telling you, knowing the difference between these two is one of the most important keys to managing your money well. Here it is, the simple breakdown. APR, that's annual percentage rate. Think of R for rate you repay. This is for borrowing, loans, credit cards, that kind of thing. Then there's APY, annual percentage yield. Think Y for yield you get. This is for saving. The huge difference is that APY actually includes the power of compounding. So here's the rule. When you're borrowing, you want the lowest APR possible. When you're saving, you want the highest APY you can find. So let's zoom all the way out for a minute. Interest rates aren't just about our personal bank accounts. They are the main tool that central banks, like the Federal Reserve here in the US, use to steer the entire economy. They're like the gas and the brake pedal. So let's say the economy is running a little too hot and prices are going up everywhere. That's inflation. The central bank can step on the brakes. They raise their main interest rate, which sets off a chain reaction. Suddenly it costs more for banks to borrow money, so in turn they charge us more for things like mortgages and car loans. That makes us all think twice about borrowing and spending, which cools down the economy and hopefully gets inflation under control. And yeah, you guessed it, the opposite is also true. If the economy is slow or in a recession, the central bank can hit the gas. They lower rates, making money cheaper to borrow. That encourages all of us to go out and spend and invest, which helps get the whole economic engine roaring back to life. It's a never-ending balancing act. All right, let's bring this all back down to earth because these big numbers and federal policies, they aren't just abstract ideas. They have a huge, direct impact on our ability to build a life, to achieve our biggest goals. I mean, just take homeownership. In early 2025, the average rate for a typical 30-year mortgage was sitting around 6.85%. Just that one number, it determines the monthly payment for millions of families. For so many people, that single number decides whether buying a home is even possible. And when we look closer, we see that access to these loans isn't always the same for everyone. Data from the Home Mortgage Disclosure Act in 2023 shows some pretty significant gaps in who gets approved. As you can see right here, both Black and Hispanic applicants were denied conventional home loans at much higher rates than white applicants were. Now, what's behind those numbers? Well, it's complicated. A Federal Reserve Board study looked into this and offered another view. They suggested it might not be about preferential treatment, but about other complex factors, like some borrowers may be choosing different types of loans that have higher rates but lower costs to get started. It's a perfect example of how layered and complex this whole subject really is. So we've seen it all. Interest is this incredibly powerful tool. It can build a fortune for you in a savings account, or it can bury you in debt with a credit card. It can cool down an entire economy, or it can be the key that opens the door to your first home. The most important thing is simply understanding the rules of the game. So the real question I want to leave you with is this. Now that you know how it works, what are you going to do to make interest work for you and not against you?